Welcome, welcome. It is always a pleasure to speak with you, Dave. I'm excited for our conversation today. Just so everyone listening knows, we have some important things that really relate to how the entire stock market system here in the US runs. There are two major things actively going on right now as we speak, and potentially some big things coming up in November, and we're going to be getting into that right now. But potentially more important, Dave, I have to ask you, I'm looking at your hat. And obviously you're a Phillies fan.
Right.
You are a Philadelphia fan through and through. And I also know you're a math guy. I know you care a lot about numbers, so you've probably seen some patterns in the past. Does the great crash of 1929 or the inflation of the early 1980s or the great financial crisis of 2008 scare you at all? And the reason I'm asking this, folks, is because those are the years that we've had, really, from a financial standpoint, a cataclysmic event. And it's also the year that a Philadelphia-based baseball team won the World Series. So what would you trade off here? I need to ask you, what would the trade-off for you be? Would you prefer that the Phillies win, or do you want to see the market down another 20%? Where are we going here?
Well, thanks for having me, Matt. It's true. It appears that bad things happen when the Phillies win the World Series. And I'm sorry, it's a sacrifice that I'm willing to make. I said it on Twitter before. I was like, I know that, this could cause some pain, but then at the same time, that pain will go away and flags fly forever.
I love that.
Nothing's
Flags
more
fly
important
together forever
than the Phillies World Series.
That is so great. Well, we'll see how it goes. Just so everyone knows, we're filming this before the final series gets going, and I'm excited. And hey, I'm an Eagles fan, so I feel like I don't watch baseball too much, but for the purpose of this, I will be rooting for the Phillies, and we'll see how it all goes. And if we have to, we could hedge by buying some puts. We can make this all work out.
I mean, honestly, I feel like everyone should be a Phillies fan. They're playing the Astros, the cheaters. So come on, we can all get on board with the Phillies this year. But yeah, it is a great time to be a Philadelphia sports fan. That's for sure. Between the Phillies, the Eagles, the Flyers are looking good. So it's a lot of fun right now.
In a weird way, I didn't think of it. Yes, I've been watching the Eagles. I haven't paid attention to the Flyers, but I do I've never connected at all that this year in terms of sports, Philadelphia is doing very, very well. And then that brings up the question, does the US of A have the infrastructure to handle Philadelphia winning multiple championships in the same year? Are we...
Markets will fall apart, that's for sure. Yeah.
Well, I guess we'll get a couple new infrastructure bills passed soon. Right. A little bit more
you do know how excellent the Philadelphia municipal authorities are at greasing telephone poles and traffic light poles, right? Because when a Philadelphia team wins, there's mayhem, and you got to grease those poles to prevent there being even more mayhem.
Wow. Well, I think they're probably loading up on some right now. I hope that there's not a lack of supply.
On Crisco or something.
Crisco. They're calling up Crisco. I love it. Absolutely love it. Speaking obviously about finances and what's going on, you and I have met maybe at this point a year and a half ago, and our relationship has been a lot about kind of the underbelly of the market. You are one of the first people who gave an olive branch to the world of the average retail trader and said, hey, I'm from this world. Here's how things are truly going on. And which was awesome because it's opaque. There was a lot of questions. A lot of people we didn't know what we didn't know. And then all of a sudden you were beyond a library of information of hey, XYZ, look at it like this, think about it like this. Here's where we need to go. And over that entire time, we've been making baby steps. I understand that there's a sentiment from the retail community that we want to snap our figures and it's fixed instantaneously, but unfortunately it just doesn't work like that. It's a very slow moving process, and that's actually what brings us to this exact conversations. There are two, SEC filings being heard right now as we speak, and I want to get into those and then maybe the things coming up in the future. So I believe the first one that's kind of the hot topic is denoted 10C-1, the Securities Lending Transparency Filing Act, whatever it is. I don't know. I'm not the one who names this stuff. Can you explain to us what it's all about and why it's important?
Sure. Yeah. I think it's a sort of, I've said it to you a bunch of times, and it still just does not cease to amaze me that there is such interest in SEC rule proposals. SEC filings. People want to get involved. I think it's great. And I'll tell you the truth. Like the SEC thinks it's great as well. They are excited that retail is becoming a more direct participant in this process. It is a good thing, and it means that the way markets are designed will change because of that. So, I can't stress how important it is to be involved in this process. And so, what you're referring to is there were a bunch of proposed rules. So the way the rule-making process works for a lot of these big changes to markets is the SEC will come out with a proposed rule, and they will put it out for public comment. Then they get comments, usually just from the industry and usually just from the largest firms. And they will look at those comments. By law, they have to read every comment. They have to consider every comment. And then they will come out with a final rule. They will often cite to all those comments. They will say why they agreed or disagreed with them, what they took from them, what they changed based on that. And then the final rule will come will be proposed to the commissioners. The commissioners vote on it, and if it passes, it becomes an effective rule. And then there's usually a time period over which it's enacted. Now, there was a set of rules that was proposed, I believe earlier this year, and they were put out for public comment. And there was a technical issue, apparently, with the way the SEC collected the comment letters, and they lost a bunch of comment letters. So this is an unusual circumstance. I've never seen it before, but they have reopened the file on a lot of or a lot of proposals, and they are accepting comment letters until November 1st. So November 1st is the new comment deadline. And two of these rule proposals, as you say, are sort of directly relevant to the issues that I know that your community and the people that I talk to on social media care about very much. So 10C1, which is the first one, is the securities lending transparency rule. And it's really funny, actually. If you read the rule, the very first sentence in the rule is the securities lending market is opaque. That's it. That's the sentence. And it's good. It's good that the SEC recognizes that. Okay. Why haven't they done something about it? I know you think they've had it, but they haven't been pressured to do anything. The industry likes it opaque, right? They like it this way. And if the SEC is not hearing from anyone else, they're generally not going to focus on these things. They don't have a lot of resources, and they have a lot to do. So, criticize them all you want. What's important right now is that there is a proposal on the table to really open up the veil, and really expose what's going on in the securities lending market. And that's important because, generally speaking, when somebody goes to sell a stock short or short other instruments, because this is a securities lending market rule, and it will apply not just to equities but also to debt and anything else it falls under the SEC's purview. When you go to short something, you go to the lending market to borrow those shares to short them. And today, a handful of firms have a lot of visibility into that market, and nobody else really does. And so the public is left with very mediocre data. Often it's too old to be useful. Regulators also don't get great data, so it makes it difficult for them to surveil markets and monitor for market manipulation. And so they've admitted that in this rule proposal.
Wait, I'm sorry to interrupt you there. So you're saying that private companies have this information, but the regulatory bodies don't. That's like the current situation right now, like private for-profit companies. Love it. Love how the market's set up. All right, sorry, continue.
Every time you peel back a layer, man, right? Every time, it doesn't matter where, you find something like that. You find a conflict of interest, or you find people hoarding information and information asymmetries, no matter where you look. And, this is a good example of where the big banks, who are the big the big brokers in the lending market, and the larger asset owners who have some visibility because they're the ones loaning out the larger positions, they have some visibility into it. There are private companies who will sell some data. There are other companies who have like give to get relationships. So if you have a lot of information and data, you can give it to them and you'll get more back. But again, this keeps information siloed. It keeps it expensive. It keeps it non-transparent. All of these things are in the SEC's rule proposal for 10C1, which would require every single securities loan transaction be reported to a registered National Securities Association, which is FINRA. There's only one of those right now. And so every single transaction would need to be reported to FINRA. And then at the end of the day, FINRA would get aggregated information, and then FINRA would have to make available anonymized, aggregated information. So that's the current state of the rule proposal. Now, the SEC, I believe, they've talked about, and they want ultimately FINRA to turn this into a data feed so that as stuff is reported to them, it gets reported on the feed. It would be anonymized, and the industry is going to push back extremely hard against that. But that's, I think, where they ultimately want to go. And so, what we've done is we put some information on our website about this rule proposal. And we haven't done as much with this as we've done with 13F2, which we can talk about in a minute. But we know people care about this issue, and they're very passionate about getting more visibility and transparency into the securities lending market. It's sort of a proxy for looking at short selling activity. It's not a perfect window into it, but it does give you some information. And again, I come from the standpoint that more transparency is almost always a good thing. And, this is definitely something that people should let the SEC know that they support, because the industry is pushing back on it.
So for people who are potentially like newer to the market, or maybe don't know exactly this jargon, please correct me if I'm wrong, but the TLDR version of this, of 10C-1, is saying, hey, when it comes to short selling, it just seems as if there's not data of those transactions, who did it, when they did it, and all the other important information of how that trade was actively made, who made it, yada, yada, yada. That's what this is all about, of giving us more information of shorts and potentially in real time. Is that a fair summation?
So sort of. Again, it's a different it's the securities loan transaction. So it's the thing that after you've sold short, it's the transaction you make to borrow and deliver those shares.
So, okay, gotcha.
So, to sell something short, what you need to do is you need to first locate shares. So you need to call up your broker and say, how many shares do you have for me to borrow? And they'll say, we have 10,000 shares. And so then, okay, you're like, okay, I'm going to go and I'm going to sell 10,000 shares short because I don't have a long position in that stock. And then as those transactions get completed, I go to my broker and I say, okay, I need to borrow those 10,000 shares now. And so the broker will say, okay, well, then there are other details that go along with that transaction. How much collateral is being put up? What's the rebate structure? Who are the parties to that loan? All of that information is what this proposal would have the broker report into FINRA.
Yeah, so maybe potentially another way to say that is that type of going short, but getting the loan or not getting the loan. I know many people who identify in the retail investing community, they talk a lot about naked shorting, which is the type of fail to deliver, FTD. So in a weird way, this type of information would kind of show, or really lack of information is probably a better way to do it, could like highlight the information surrounded naked shorting, really, because you're like, oh wait, this loan was never acquired, even though that person went short. Is that a proper connection to make?
Yeah, so I think with this rule, this would expose the lending transactions for short selling that are done properly.
Okay.
And so I think it more in terms of like 13F2 would be, that is something that would probably expose, if there are an excessive number of short positions out there, right? So between 10C1 and 13F2, I think we can finally get a handle on what the actual short interest in a name is, and especially what the economic short interest is, assuming that the rules are modified in the ways that we think that they should be.
So speaking of that, maybe this is the perfect time to really showcase what the major aspects of 13F-2, which is short position disclosure. So with that, obviously, that's a title that I think some eyebrows are going to be raising, like, okay, like what's going on here? So could you give us the high level version of that one?
Yeah, and a lot of your viewers might be familiar with 13F filings, right? Yeah. So anytime, every quarter, every hedge fund, every asset manager has to report their long holdings in their 13F filings. But for some reason, until now, they have not been required to report short positions. And so the SEC as instructed by the Dodd-Frank Act, is looking to change that. And actually, both of these rules were part of the Dodd-Frank Act, and it's taken the SEC an awfully long time to get around to this rulemaking. But to be fair, the Dodd-Frank Act did mandate like hundreds of rules that had to be created. So 13F2, as it's currently structured, would not be the same as 13F. And so you would not get firms individually disclosing what their short positions are. The regulator would get those. And so the regulator would get information from these firms as to what their short positions are in stocks. And then the regulator would publish aggregated, anonymized statistics.
Okay.
And so that's how the rule is written today. So certainly that would be an improvement in terms of transparency from where we're at right now. But we believe very strongly, and this is why we're asking people to write comment letters, that we should go much further than this, and that the SEC should really simply replicate what they do with 13Fs on the short side. And very importantly, that those disclosures should include all economic short exposure. So not just shares you've sold short, but also any derivative positions that you have, especially around, swaps and that type of thing. And we talk about Archegos and how a disclosure such as this would have prevented Archegos, because it would have given Archegos's brokers enough data to understand what Archegos's economic short or long exposure actually was, because 13Fs don't include derivatives today. And how important a disclosure like this is in terms of systemic risk, both for brokers who are extending capital and collateral and margin to firms, as well as for individual investors who simply want to know how much is there that is short in this name, right? Today, it's very hard to get an accurate measure of economic short interest in a name on a timely basis. And this would really change that.
So between these two rules, the first one is more information related to the lending. That is obviously an important step in the process of shorting. And then the second one is more so the big guys. I believe the number is over $100 million in assets under management is like when you have to file these of their shorts, because we know they're long positions. And I'm assuming the pushback from them is we don't want our shorts public because then maybe we'll lose some sort of competitive edge. But to me, and maybe I'm missing something, but on the surface level, wouldn't that have been the same argument for your long position? So like, I don't understand how you're losing your competitive edge is different in one case than the other. Am I missing something there?
No, you're not missing anything. There are two standard arguments that the industry uses every single time the SEC proposes a new rule. The first argument is this is going to cost us too much money to comply with. And the second is people will be able to reverse engineer our trading strategies. Every single time there is a new rule around disclosure or transparency, those are the arguments that are made. I've seen it over and over again, and it just seems silly to me. And that's what we put in our letter. Right? Not quite that it seems silly, but that it just doesn't hold water, because first of all, we already have 13F logs, and so these firms that are writing comment letters about how they can't disclose shorts because of copycats and the inability to get into positions in a timely way, the same is true for the long disclosures. And I mean, there's a whole industry that's sprung up around following the 13F filings, helping people replicate those trading strategies, getting them in as quickly as they can and responding to them, measuring which insiders are buying what did Bill Ackman disclose that he's in, and what did Carl Icahn disclose, and all of that, right? And that moves stocks. And that's fine. Like, I don't see the problem with that. And I think we should have the same on the short side. The idea that they can't do it because of copycat trading, again, it's the same thing. There's no difference from the long side. There's no difference from politicians, right? Politicians have to disclose what they're doing. And now we have, ETFs proposed to follow what politicians are doing. So, again, it's like any disclosure is going to lead to that kind of thing. And that's just because you're getting visibility into an area it's important to have visibility into. And then, the cost of compliance, again, these firms are all tracking this information already internally, having to report it out. And there were a couple of very good comment letters on both of these rule filings. of firms who would have to incur cost, and they laid it out. They're like, here's what the cost would be, and we're fine with that. This is not a huge cost. This does not prevent us from doing business. We're small companies, and we're okay with it. And you know, there are ways, even with 10C1, you know, maybe we can put a threshold in there so that you don't need to report if you're tiny. And that's what they're talking about with 13F2 is, you know, there is a threshold, like you said. And, you know, one of the SEC's questions, should that threshold be lower? And, you know, I think they're going to capture something like, I don't remember the exact number, but let's call it 85% of all funds with the current proposed threshold. And from an assets perspective, far more than that, because, you know, you can imagine if it's everything over, you know, a certain threshold, all the big guys are captured, and those are the ones with all the assets. But, you know, again, we said we think the threshold should be lower, and you should be trying to capture 95 to 99% of firms. But, you know, I don't think that that's a huge and material part of what needs to change about this bill, about this rule. I really think it's about getting those individual disclosures and making sure that derivatives are part of that disclosure.
Awesome. So with that, this has been quite a bit of a conversation about like shorts and short reporting and kind of knowing who's doing what. And also, just to clarify, this is not instantaneous, especially in terms of 13F. It's at the end of the quarter. I just want everyone listening to know that no one is saying that whatever hedge fund out there should tell us at the end of that day. It's at the end of the quarter, and it's just been going that way for a while. But another big thing, particularly in this community, is payment for order flow. And yes, I want to talk a lot about what's coming up in November of this year. But before we get into that, I needed to pick your brain, because it seems like maybe sometimes we're in our own echo chamber and we see it through the lens of retail. So I think sometimes it's beneficial to try to see it through the lens of these hedge funds and market makers and all of that. So I think a perfect highlight, what I have here, is recently the chairman of the SEC, Gary Gensler, was actually on a podcast with Jon Stewart, The Problem with Jon Stewart. And I implore that you guys listen to the whole thing. I'll put a link below. But at one point in it, Jon Stewart was asking the SEC chairman right now if you believe payment for order flow is a conflict of interest within the market. And as he was about to finish that, right away, Gary Gensler stepped in and said, it is a conflict. He cut him off, and he just like straight out said that. And then he's like, then why not just ban it and go to court and like fight with it in court? And then from there, for those of you who don't know about payment for order flow, market makers, and it's the game of like siphoning off a portion of a penny on many, many trades. And in reality, there's various other interviews I've actually done with Mr. Dave Lauer here that says this in totality adds up to billions of dollars. And then the major thing is more so of a conflict of interest. But what I found so interesting from that, because it's not necessarily the focus of this particular discussion, is Doug Cifu, who is the CEO of Virtu. So everyone knows Citadel Securities and Virtu are the top two dogs in the world of market making. Doug Cifu, the CEO of Virtu, responded to that recently in the month of October, laughing face, laughing face, laughing face, laughing face, warning people about payment for order flow. Yes, this is very informative about the level of journalism that we would expect from a late night comic. Gary Gensler, why are you bothering with this nonsense? Come engage the industry publicly with facts and data. Clown face, clown face. Now, hey, I'm a dumb 28-year-old. I know how to Google stuff, though. So I Google Virtu, I Google Citadel Securities, and I find out that in the year, Virtu is going to clear over $1 billion. In the first half of 2022, Citadel Securities had a record revenue of $4.2 billion. So on the surface level, I'm like, well, of course you're going to argue that, because you're not lining your pockets, you're lining your diamond encrusted gold pockets. That's what you're doing. So like, I get the argument, but what is the devil's advocate point here? Like right there, he's speaking with Jon Stewart. You've had the opportunity to engage with some people who really know what's going on in the underbelly of the market. So why doesn't this happen? Like, I guess am I missing something in the Citadel Virtu argument? And not just in payment for order flow, but even the point of disclosures, because if I had to bet any amount of money, I would bet that they're also against it. But maybe more important here is, why is there no public discussion? Like, why does Gary Gensler not sit down with the likes of you and Doug Cifu and Ken Griffin and whoever else has like the credentials to speak there? But like, why don't we see that?
So I think it's because it's kind of unnecessary. Gary Gensler has sat down with Doug Cifu. He sat down with me. And I've sat down with Doug Sifu, and Doug Sifu used to pay me to advocate to end payment for order flow. So just a few years ago, Doug Sifu paid me to try to end payment for order flow before Virtu bought KCG. And once they bought KCG, suddenly they are, in favor of payment for order flow. Now that's fine, right? Like Doug Sifu makes a crap ton of money from payment for order flow and off-exchange internalization and trading. And so, of course, he should be arguing for it. Now, why he's a hypocrite and a liar is because he says that there is no data-driven argument against payment for order flow, which he knows is false because, again, he used to pay me to argue to end payment for order flow. And he also knows, as that pure hypocrisy, that the argument against it is extremely compelling and rational. And so all he has are ad hominem attacks, right? That's all he can do.
And emojis. He does have
emojis. Yeah, emoji game, which is very lame. It's a boomer game, right? So he's a boomer emoji guy. And, look, boomers have ruined the world, right? Like we can all agree on that. And he's continuing to try to ruin the world because he's greedy and he wants to make more money. Now, it's insane when he argues and denigrates and attacks people the way he does, given that he used to be on the other side of the argument just a few years ago. And he's hoping that people don't remember that or that they don't know that. And I think it's just completely callous and disgusting that he does this. Now, you want to argue the merits. That's fine. And look, I know people at Virtu. I talk to them on a somewhat regular basis. I like talking to people who disagree with me. And, a lot of people there obviously disagree with me, but like to engage. And we talk. Like there's the community of people who like market structure and are passionate about it is, for a long time, was very small. It has expanded, but for a long time, it was very small. We all know each other. We all talk about this stuff. We know what the arguments are. Virtu will say, look, retail has never had it better. They get great price improvement. They get instantaneous execution. They get size improvement, all of this. Now, we put together a comprehensive presentation under We the Investors after our sign-on letter to Gary Gensler got 71,000 plus signatures. And we put together this comprehensive presentation that went through the data and talked about the problems with payment for order flow and picked apart the arguments that the internalizers are making. Now, I just want it to be clear that they can make arguments and they can come up with data. And there's not a lot of good data out there that you can find because they are hoarding the data, right? We're back into this. We don't have good disclosures. We don't have good transparency. And there's a dramatic information asymmetry at work here. But there's enough data to clearly demonstrate that spreads in the market are far wider than they otherwise would be. And so it's a cost that everyone is paying. So yes, there is maybe a theoretical benefit on one side of this mythical price improvement. Now, I think price improvement is bullshit. It's a complete false measure. It's a theoretical measure, right? It measures against the NBBO, the National Best Bid and Offer, but it doesn't include hidden orders, midpoints on exchange. It doesn't include odd lots. And it's an NBBO that is wider because of the very practice that they're defending and thinner. There's not as much size on the NBBO because of this practice, because by taking all these orders off exchange, you make exchanges more expensive. And so, this is not like a very controversial thing. What I'm telling you here, the arguments against it are not controversial. You ask any major institutional broker, they're going to agree. You ask any major institutional asset manager, they're going to agree. You ask any high-frequency trading firm who doesn't engage in the practice, and they're going to agree. It's just the zero commission PFOF brokers and the internalizers who push for this practice to continue. And they only push for it because they make so much money from it. So they can say all they want. They can put all the emojis that they want. None of that changes the fact that it's an argument that's coming from a place of greed and that regulators see through that. So, I'm not too worried about that. Why, John's question about why don't you just ban it? I mean, I agree, right? You know how I feel. that doesn't mean that that's going to work from the SEC's perspective. And if it is going to work, they're going to have to do it in the right way. And so there are a bunch of proposals that are about to come out, and they won't be what we want them to be, which is the nature of the regulatory process. But we have the opportunity through the commenting process and by meeting with the SEC to change the direction and to influence those rules, to make them the way we want them to be. And maybe that's what the SEC needs. Maybe they want them to be the way, maybe they agree with us. I think they do. I think the SEC is on board with these kinds of changes. But to make such dramatic changes to markets, they need to know that people want them to make those kinds of changes. And that's what the public comment process is all about.
So looking at payment for order flow, which has been discussed ad nauseum, and then also even these, like the opaqueness of short reporting, or I should say lending, but then also short reporting with especially these big players, is it one of these things that it hasn't gone that way because someone's pushing against it? And now saying it out loud, obviously that's what's happening with payment for order flow. But maybe in light of the first two, the main two filings that we're talking about this time around, is it more so that they just didn't write the rules like to the best of really how reality played out the first time around? Like, is anyone legitimately arguing against the first two rules? Is there a pushback, or is it more of like you said when you were referring to Dodd-Frank, there's just so many, and like of course you're not going to write everything 100% perfectly the first time around? Is that more of the issue?
Well, first of all, look, it took Dodd-Frank to even get the SEC to do these rules, so they weren't going to do it before that.
Okay,
and that's because the SEC listens to the people that they talk to, right? And they pretty much only talk to industry up until now. There have been some associations that have tried and with mixed success. But retail, in terms of individual investors who want to be a part of this process, have hardly ever showed up into the actual process. And so I think this is really a unique time that we're experiencing, where the SEC sees that there is popular interest in these issues and knows that they have to respond to that. Like these are real people. They respond to pressure. They respond to public pressure. These are, the commissioners are politicians. The staff are, again, real people who mostly care about markets, unless they're going through the revolving door, which, is some of them, but not all of them. And so, I do think that there is pushback, right, and against these two rules, and there will be pushback against the proposals that come out in November. And sometimes that pushback is just comment letters being filed, and sometimes it's firms suing the SEC, right? The exchanges have sued the SEC before to prevent a pilot study. Citadel sued the SEC to make them remand like a rule that they had approved for IEX for a complex order type. And so this will likely, a lot of this stuff will likely end up in the court with firms suing the SEC. Now, luckily, generally speaking, the courts defer to the regulatory agencies. Now, there was a recent decision that was like West Virginia, I think, versus the EPA that kind of, poses a sort of new regime of that deference not being unconditional, let's say. It's a very complicated way of saying that the court said, no, EPA, you cannot do everything you want. Mm-hmm. And other courts have said to the SEC, no, you cannot do everything you want, especially with like the administrative judge, cases. But, aside from that, generally the SEC has had a lot of success in court defending itself and defending its regulation. And having comment letters from the public and having, filings in those court cases from the public, which might be necessary in the future, helps to bolster, that argument, helps to bolster the case of reform. So, these firms push back, and they even if it's not reasonable, they're going to push back because they're going to try and delay, and every day that payment for order flow reform is delayed is another day that these firms print money. And so for them, they will just delay as much as they can to print as much money as they possibly can before that, that golden goose is taken away from them. And, I think the same is true on these transparency and disclosure proposals, that firms will just push back and delay as much as they can to avoid the cost of complying and to avoid the scrutiny that will come from such transparency.
It very much seems as if it boils down to, in this effort for retail fighting for like a fair and equitable market, or at least more transparency, it's the classic, the squeaky wheel gets the grease. And right now, the whole point is to be as squeaky as possible. And what's nice is retail has the voice, and then we're fortunate to be connected with people such as yourself, that it's the legitimate argument. Like, we're the voice of say, hey, look at us. And then you and your team and people such as yourselves, you're like, here's the actual data. They're just not screaming for no reason. Like, it's backed up by legitimate right, quantitative like information here.
It's true. We're making very reasonable claims. We're proposing very reasonable things, that trades should happen on exchange, and that we should make those exchanges compete on a level playing field. Make the internalizers compete on a level playing field. If you do that, no one's going to go to them anymore, because right now they have an advantage that you can't get on exchange. And that's a problem, right? They talk about it like the great free market has created this system, and these bad progressive regulators are coming in to be communists and Marxists. And it's like, it couldn't be further from the truth. Like, Wall Street is the most regulated industry in the world. And this area is explicitly created by regulation, and it's regulation that has picked winners. The existing regulations have picked these internalizers as winners. And we need to undo that, right? It's not a level playing field today. And if we make it a level playing field, and we simply say everyone should be able to compete for all orders, then those firms will go away. And maybe not. Maybe they'll compete great, and they'll be still happy and making a lot of money. But competition, in my mind, is the most important thing in markets, and that's all we're pushing for.
Yeah, I definitely 100% agree. A couple times you've referred to things coming up in the near term here in November. I don't know if it's concrete in terms of it specifically announced, but could you tell us about like what you're personally looking for in November, or that might be announced from the SEC or might not be announced from the SEC?
Yeah, sure. So, what I've heard is that, first of all, Chair Gensler has been talking about this for most of the year now, that our markets need a regulatory overhaul, that, the current framework, which is called Regulation NMS, National Market System, which was passed in 2005, is old, right? It's 17 years old. It was written, as Wall Street had barely computerized, and things are different now. And so that framework needs an overhaul. And very few people would disagree with that, except for the rent seekers who make a lot of money from the current inefficient system. And so, what I think we're hoping for, and what he has laid out in the past, is that there are several areas that they're focused on. And I think in mid-November, what I'm hearing we're going to see some additional disclosures and a modernization of Rule 605, which is great. That's another thing I've been pushing for 10 years now, which is the execution quality disclosures that firms have to get, exchanges and dark pools have to issue. So hopefully those disclosures will be modernized. For example, like, they have to tell you how fast they execute an order, and it's bucketed, and the first bucket is 0 to 9 seconds. Okay, so there's nothing that takes 9 seconds in this market, right? Everything takes like 10 milliseconds. So, 100 milliseconds. So, that it's an example of something, it needs updating, right? Another thing is that the SEC has talked about them proposing a best execution standard. Today, the only best execution rule is through FINRA. The SEC doesn't have one. So that would be a good thing, and sort of hard to argue against. They are looking at what they can do in terms of retail orders, and how retail orders should be handled. I still hear that they want to institute what's called a retail auction facility, which would involve, anytime you send a small marketable order, instead of that order being routed to a wholesaler like Citadel or Virtu, that order would have to go to an auction facility where anyone could compete over it. And then the last thing, I believe, is going to be tick sizes and the NBBO. So improvements to what the NBBO reflects, like including odd lots and maybe changing some other things about how the NBBO is calculated. And then changing tick size. So today, the quote and trade increment on exchange is a penny, right? Everything, the tightest spread you can have is a penny, because when you put a bid in the market, you can only price it out to 2 decimals. And when you put an offer in the market, you can only price it out to 2 decimals. So, the increment is a penny. But off exchange and the internalizers, they don't have, they have a restriction in terms of quoting, but they don't really quote. And they don't have a restriction in terms of trading. So that's why when you see price improvement, you see trades that happen out to 4 decimals. So you get 1 mil of price improvement on your order. So they're like, that's like Doug Sifu throwing a nickel over, being like, here you go, buddy, and pocketing his dollar and thanking you for it, right? Or telling you should thank him for the nickel, right? So that's what's happening today. So, that's an example of how there's just not a level playing field. And the fact that internalizers can trade at 4 decimal places means that through regulation, the regulators have allowed them and chosen them to be winners and chosen the exchanges to be losers. So if we can even out that playing field through a change to the quote and trade increment, so make it tighter so that, for example, we can quote half penny for some names, and maybe even make it wider for other names which are less liquid and would benefit from wider increments, and then force the off-exchange trading facilities to respect that quote and trade increment. That's the kind of thing that will level the playing field. So those are the 4 areas that I believe they're looking into. And then I think we're going to see proposals out in mid-November. We had a lot of conversations with commissioners and staff about all of these things and what we think they should look like. I don't know if that's what they're going to look like, but as soon as they come out, you better believe we're going to be all over that. We're going to be summarizing them, putting up, bullet points about what they're about, what they're saying, putting suggested comment letters together for people to file, just like what we're doing for 13F2 and 10C1. And, like I sent you the URL that you can point people to if they want to comment on 13F2 and 10C1, which, like I said, they have until November 1st. And then once, this new set of proposals comes out, we're going to do the same thing, probably more so because, we've gotten some experience now with the comment letter campaign, and we're going to know what to do better the next time. And we'll have a lot more time once these things are proposed. And, again, you can be sure the industry is going to come out, at least the wholesaling and, zero commission and PFOF broker industry is going to come out heavy against all of this. And so it's going to be up to retail to show up and to tell regulators that those people don't represent them. They don't represent their interests. They only represent their own annual bonuses. And that's not how we should design markets. And, we're going to push to make sure that these rules are modified to be the best that they can be. And I think we're going to see the biggest overhaul in markets, like I said, that we've seen in 17 years. And that's a really big deal.
Yeah, it sounds like between now and the end of the year, in terms of the SEC, it's going to be pretty crazy. And then I'm assuming 2024 is going to be even more nuts. And now I guess potentially for the most important part of this particular discussion, we've talked a lot about the squeaky wheel gets the grease and getting the SEC to hear us and the rise of retail. And you've alluded to a little bit of we the investors and you're saying comments. And I think we need to be very specific because even if we get one person watching this to truly understand what that means, these comments, like you can send this into the SEC. And just so everyone knows, all of Dave's information, his website, the We the Investors, his Twitter, it's all going to be in the description of the video. Everything you could possibly need, the link to the videos, the links to the information, everything's in the description below. So feel free to just check that out. But could you tell us about We the Investors, the tool that you're currently building to help retail even more terminal, and really, I believe, the overarching thing of Irvin Finance?
Yeah, sure. So, Irvin Finance is the company that I'm the CEO and co-founder of, and we just launched as a company, a little more than a year ago, last June, and we launched because we saw the kind of data that retail had access to, and we were shocked at how bad it was, and we saw how retail investors and individual investors are coming together on social media to understand markets and to share information and share investment theses. And we thought that's a great thing. And it would be great if they had a platform that was built for that, for them to do that. And so that's what we're building with the terminal. So the terminal, which is being opened to our first set of beta users this week, which we're very excited about. And we've had almost 1,000 people on it who are our investors because we the way we funded our company was through crowd equity funding. So, we got our community to invest in us, to own a piece of our company. And we are currently running a crowd equity raise right now. It runs through the end of this week. So there's not much time, but October 28th is the last day that people can invest. And if they're interested, again, the link I think will be included here. And we're selling shares in the company. This isn't donating money. You're owning a piece of the company, and we love that we are being funded by the community and by the people who will use our website and our platform. And that is inspired by this very community who came together around certain stocks and certain companies and loved those companies, and they became the most passionate users and most passionate advocates. And we said that's a great model to build a business. And so the terminal is a platform that will bring professional quality data and tools to individual investors, and provide a community platform very similar to Reddit, where people can discuss stocks, they can discuss investment ideas, they can take the data and data visualizations that they create on our platform and embed those into posts. And it will also have a full featured education section to teach people about markets and investing and financial literacy and how to value companies and all of that. And we're getting just experts from around the industry to help create that content and record information. And it's just been a great experience. So that's Irvin Finance, and that's the terminal, which is the platform we're building. And at the same time, we are leading this grassroots advocacy campaign that we call We the Investors. And, this is truly a grassroots campaign. It is all volunteer driven right now. And we volunteer our time as well. And We the Investors is an attempt to empower retail investors to represent themselves in these debates and in these discussions, and to be heard by regulators and legislators. And up until now, firms like the wholesalers, Citadel and Virtu, and firms like these PFOF brokers would go to regulators and they would go to Congress and they would say, we represent retail investors, which is ridiculous, right? Mm-hmm. They productize retail investors. Retail investors are not their customers. Customers who pays you money. Mm-hmm. So what we're trying to do is change that narrative and show that retail investors can understand markets, and they can understand market structure, and they can represent themselves, and they can be heard. And that's what we're all about, that we want to see markets changed, and we want to see more thoughtful regulation and more thoughtful legislation, because Congress is involved and Congress cares about these issues. And Congress cares when their constituents care about these issues. So, I think there's a great opportunity right now to make Congress hear what we're saying, to make regulators hear what we're saying. And that's what we're trying to do with We the Investors. And, again, the website that we've put up for helping you understand the commenting process, how to write a good comment letter, suggestions for text that you can use, that's all up there. We ran a campaign, like I said before, to send a letter to Chair Gensler on payment for order flow that was signed by over 71,000 people. And we're going to have a second letter coming out really soon that will focus more on failures to deliver. It will focus more on DRS and how to own your actual stocks and change the way that beneficial ownership works. That will shed more, that will encourage regulators to shed more light and increase transparency on things like margin and netting and FTDs. And so that's the next effort. So I think, what we're trying to do is finish what we're doing now, which is the payment for order flow stuff and, the commenting on 10C1, 13F2. And then, pretty soon, next month, we're going to have all these new rules come out, and we're going to be pushing our other initiatives around FTDs and other types of transparency and control for investors.
On a personal note, to everyone watching this, I can fully admit that We the Investors is by far the most efficient way for you to get your voice legitimately heard by the SEC and other various regulators to fight for this fair and equitable market. It is comically easy it's comical how easy We the Investors made it to be heard. And then for more you personally, Dave, I'm just excited to check out this beta on Terminal. I'm on the wait list. I'm ready to go. And I think it'll be cool. I like the screenshots. It looks awesome. Like the UX seems incredible. And just knowing you and the team surrounding it, I think it's going to be an amazing tool for retail. So it looks the end of this year, the start of 2024, all seems to be very, very exciting times. Once again, for everyone listening, all the information we discuss will be in the description of the video. You're not going to be a question for anything here. So just to wrap it up, as always, Dave, I truly, truly appreciate your time. I'm sure everyone watching this does. It's always, always a pleasure. And I hope we could do this again before we bring in the new year.
Yeah, thanks, Matt. Me too. Really appreciate you taking the time and spreading the word and getting people to care about these issues, which is just so important and impacts people's everyday life, whether they recognize it or not. And it's just a thrill that people care about this and that so many do, and that we can get the word out. So thanks.
Yep. As always, a pleasure. Thank you. Thank you.
Go
Perfect.
Phillies.